Welcome to Talk Tickers. We're your shortcut to getting smart on earnings calls.
Straight from the source.
Today, we are doing a deep dive into ATS Corporation, specifically their fourth quarter and full year fiscal 2025 results.
Yeah, the call was back on May 28th.
And our mission here is simple: give you the essential takeaways, the key numbers, management's view on things, where they see the market going.
And the overall feeling, I think we agreed, was sort of cautiously optimistic.
I'd say so. Fiscal 25 definitely had some, let's call them challenges, but they seem to have finished strong.
Right, with real momentum building, mostly thanks to those record bookings they announced.
That caution, though, it definitely came through. You could hear the difficulties, especially in one specific area we'll get into.
But yeah, the other parts of the business, plus some pretty decisive moves they made, look like they're setting up fiscal 2026 much better.
Okay, so let's hit those headline numbers first. Anchors the whole discussion.
For the full fiscal year 2025, the standout number has got to be the record order bookings. $3.3 billion.
That's a big jump from the year before.
Huge. And Q4 wasn't exactly quiet either. Bookings came in at $863 million.
Which I think they said was the third highest quarter ever for bookings.
That's right. Third highest in company history.
And all that booking strength leads to the order backlog, right? Where did that end up?
Sitting at about $2.1 billion. And that's significant because, well, it's the highest backlog they've had in the last 8 quarters.
Which means, for you listening, that gives them visibility. They can see revenue coming down the pipe from orders they already have.
Exactly. And backing that up even more is the trailing 12-month book-to-bill ratio.
Which was?
A very healthy 1.23 to 1. So for every dollar billed, they booked $1.23 in new orders over the year.
And importantly, that wasn't just one hot segment carrying the load.
No, that's the key thing, I think. It was above 1 in every single market vertical. Broad-based demand.
Okay, but if you just look at the Q4 numbers themselves, the revenue and earnings year over year, a bit different.
Yeah, that's where you see the other side. Adjusted revenues in Q4 were $721 million.
Down year over year.
Down year over year, though it was up sequentially from Q3 by over 10%.
And adjusted earnings from operations.
$74 million. Also lower compared to Q4 last year.
So there's the tension, right? Q4 itself, looking backwards year over year, shows the headwinds they dealt with.
Mostly related to things they spent the year working through.
But then you have the surge in bookings, that record backlog, the strong book-to-bill.
All the forward-looking stuff, those indicators are saying, okay, fiscal 25 had issues, but look at the momentum now heading into fiscal 26.
Exactly. You got to look past just the trailing numbers to the leading indicators here.
And the foundation for growth looks, well, a lot stronger than just the Q4 year-over-year numbers might suggest on their own.
Now, one really big piece of news from the quarter, something they focused on quite a bit, was resolving that situation with EV customer.
Right, that's finally settled. They announced and finalized it.
Which must be a relief, getting that uncertainty off the table.
Absolutely. So the deal is they expect to receive $134.75 million US dollars.
Which translates to about?
Using their Q4 rate, roughly $194 million Canadian. And they expect that cash before the end of fiscal Q1 26, so very soon.
And how did that settlement hit the Q4 books?
The after-tax impact was about $129 million Canadian, and that was reflected in the Q4 results you see.
But they clarified how it was classified on the income statement, didn't they? It shifted slightly.
It did. It ended up being a reduction in revenues of $146.9 million and then $24.2 million booked under SG&A expenses.
But crucially, this didn't change the bottom line numbers they'd already flagged.
Correct. No change to the preliminary net income or adjusted earnings they'd previously talked about, just where it sits on the P&L.
Strategically, though, this settlement is pretty important.
Oh, definitely. Resolving it brings clarity. And management pointed out it should reduce their net debt leverage by about half a turn, 0.5x.
Which gives them more financial flexibility.
Exactly. And they were pretty clear that settling now, given, the softer market conditions in transportation overall and the tariff noise, they felt this was a good outcome, gets it behind them.
That flexibility is key. Let's dig deeper into the financials now, beyond the headlines. Q4, adjusted revenue down year over year, but up sequentially. What was the main drag on the year over year?
It really came down to lower transportation revenue. That segment really pulled the average down.
But it wasn't all negative.
No, that drag was partly offset. They saw organic growth in life sciences and consumer products, plus you had contributions from acquisitions like Paxiom and Haydoff kicking in.
And the drop in Q4 adjusted earnings from operations, that 23% decline.
Again, mainly tied to those lower revenue volumes, with transportation being the primary driver of that year-over-year fall.
Okay, shifting to margins, there was a positive note on gross margin in Q4, right? Excluding some acquisition stuff.
Yeah, Q4 gross margin, excluding acquisition-related inventory charges, was 29%. That was actually up 90 basis points year over year.
How they managed that with lower revenue?
They said it was mainly due to a more favorable mix. So the projects contributing revenue in Q4 just happened to be higher margin ones, which helped lift the overall percentage.
And on the cost side, SG&A expenses, excluding certain items, were up year over year.
They were. Main drivers were integrating the acquired companies, which adds cost plus higher employee costs, and some FX translation impact.
But they're working on efficiency.
Yeah, they mentioned ongoing efforts there, both in the core business and the new acquisitions.
Okay, and adjusted earnings per share landed at 41 cents, down from last year.
Which follows logically from the lower revenue volumes we talked about.
Working capital. That was another area they discussed. It looked high at 22.4% of revenue in Q4.
It did, but they gave important context. If you pull out that big EV settlement receivable, which is basically cash coming in the door soon, working capital was actually just over 15%.
Which is closer to their target range, though maybe still a bit above the low end.
Right. Their target is usually 15%, 18%. They talked about the pushes and pulls. A smaller transportation business actually helps working capital because those projects can be intensive. But some of the recent product-based acquisitions need inventory, which uses working capital, offsetting that benefit. They said they have initiatives running to improve efficiency and get closer to that target range.
What about investing back into the business?
Yeah.
CapEx.
They spent $78.1 million in fiscal 25. For fiscal 26, the coming year, they're guiding $80 million to $100 million.
Focused on.
Prioritizing innovation and the growth areas they're targeting.
And all this flows through to the balance sheet leverage. Net debt to adjusted EBITDA was 3.9 times pro forma at year end. Their target is lower, isn't it?
Yeah, target is 2 to 3 times, so 3.9 is definitely above that.
But the EV settlement helps here too.
Significantly. Receiving that cash in Q1 will bring that leverage ratio down quite a bit, moving them closer to the target range.
They also mentioned buying back some shares.
Yeah, early in Q1 fiscal 26, they used their NCIB program to buy back about $10 million worth of shares. So some capital return happening, but getting leverage down seems like the main priority for enabling future, maybe larger M&A.
So summing up the financials, Q4 had its issues, mainly linked to transportation in FY25, but bookings and backlog point strongly towards growth in FY26. How's their overall outlook shaping up?
Management sounded pretty confident about returning to positive organic growth in fiscal 26.
And that confidence comes from?
Directly from that record backlog we keep mentioning and the fact that book-to-bill was positive across all their market verticals. Demand looks solid basically everywhere.
They gave guidance for Q1 fiscal 26 revenue, the current quarter.
They did, a range of $680 million to $730 million.
Which, at the midpoint, is a slight bump up sequentially from Q4's $721 million.
Modest sequential increase, yeah.
And expanding margins is a big priority for fiscal 26. How do they plan to get there?
Couple of key drivers they highlighted. First, those higher margin life sciences projects moving into bigger revenue phases. Second, getting the transportation business profitable.
After resizing it.
Exactly. Resizing the cost structure, aligning it with current volumes. They expect it to contribute positively in FY26 instead of being a drag.
And the ongoing efficiency stuff.
Absolutely. Continuous improvement through their ATS business model or ABM tools. Things like operational initiatives, resource planning, simplification, all aimed at boosting efficiency and supporting those margin goals. ABM is kind of their internal playbook for running the business effectively.
Okay, let's really get into those market verticals now. That's where the growth story is. Life science is always a big one for them.
Still a major strength, $1.2 billion backlog there. They're seeing continued strength in key areas like auto-injector assembly.
Which ties into things like the GLP-1 drugs everyone's talking about.
Precisely. That needs massive, complex automation. Also, radio pharma, wearable devices, think diabetes care, and other complex medical devices.
And the pipeline, the opportunity funnel.
Very strong. driven by demand in all those areas. GLP-1s, yes, but also diabetes wearables, automated pharmacies, contact lenses, pharma detection and treatment stuff. They're also exploring new niches within life sciences.
And they have multiple customers in that hot GLP-1 space.
Yeah, they made a point of saying they work with over 8 different customers there, so it's diversified. They did add a slight note of caution, though.
Which was?
Some customers, particularly in lab research, might be evaluating capital spending, but they haven't seen any material shift yet, just something they're watching.
Energy, another strong performer with record backlog and book-to-bill over 1.
Yeah, energy's got a really strong funnel, too. It's all about the global push in the nuclear industry.
Near-term and long-term.
Both. Near-term, demand from CANDU reactor refurbishment projects, especially here in Canada. Longer-term, it's the global drive for new nuclear builds, both the big traditional reactors and, crucially, the growing interest in small module reactors, SMRs.
And ATS does more than just, build the reactor parts.
Oh, yeah. Their capabilities span the whole life cycle, from design to automating the factory production of SMR modules, even handling nuclear waste. They specifically called out winning more work in nuclear fuel production, which is critical.
So they're really plugged into that whole energy security and decarbonization trend.
Definitely seems that way.
Consumer products also hit a record backlog. What's driving that?
They said the funnel there is stable with some nice niche opportunities. A lot of the booking strength recently came from warehouse automation and packaging solutions.
Helped by the Paxiom acquisition.
Heavily supported by Paxiom, yeah.
What's special about their warehouse automation offering?
They described it as a niche solution that helps customers meet specific sustainability and efficiency targets. And importantly, they can build it in region for customers, which fits that localization trend.
Transportation. Sounds like a different story there.
Yeah, the funnel was described as stable, but with smaller opportunities than before. That's mainly due to softer end market demand, especially in the EV battery manufacturing space globally. Things have cooled off there a bit.
But they did get a new EV order.
They did mention one additional EV order in Europe recently, but the main message was, we've right-sized this business for the current market.
And expect it to be profitable in fiscal 26.
That's the expectation, yeah, after being a drag previously.
Okay, food and beverage,
Yeah.
strong funnel, $258 million backlog. What's the strategy there?
Diversification seems key. They're pushing into services, secondary processing, and leveraging Paxiom's packaging capabilities.
To smooth out seasonality.
Exactly. To offset some of the ups and downs you get in parts of that business, like their traditional fruit and vegetable processing equipment side.
Yeah.
Building more stable revenue streams.
And after sales. That's becoming more strategic, isn't it?
For sure. They talked about evolving their service plans, offering higher value services, rolling out more digital tools.
Like the Connected Care Hub.
Right. The goal is to get customers signed up for these, improve retention, and really position ATS as a partner for optimizing productivity using digital tech and data from all the machines they have installed globally.
Moving beyond the verticals, what are the big strategic priorities?
3 main things came up repeatedly. Their ABM culture and driving efficiency, M&A, and innovation.
ABM inefficiency.
Yeah, they highlighted their annual internal Kaizen events, focused on strategic stuff like resource planning, simplification, product development, quoting processes, operational efficiency. It shows that ABM way of thinking is really embedded.
M&A, you mentioned deleveraging as a focus, but are deals still on the table?
M&A is definitely still part of the long-term plan. They're actively cultivating opportunities. But yeah, short-term, the focus is integrating Paxiom, Haydoff, Midderdy, and getting that leverage down towards the 2-3x target.
So M&A is kind of paused then?
Not entirely paused, I wouldn't say. Maybe larger deals are harder right now. But they said their cultivation funnel is strong. They're lining things up so they can move fast when the balance sheet allows.
And they might stretch a bit for the right deal.
They hinted at that, yeah. Said they'd consider financing alternatives for really good value-creating deals, even if leverage was temporarily above target. So flexible for the right opportunity.
And the third leg, innovation.
Key for staying ahead. They're putting money and people into creating differentiated solutions. For fiscal 26, they mentioned expanding use of their Symphony control platform, adding more digital apps like a digital tomato for food and beverage, and adding features to their SuperTrack system.
Yeah.
Basically using tech to add value.
They also touched on the wider macro picture, tariffs, that kind of thing.
They did. Acknowledge the geopolitical and trade tensions create uncertainty.
Seeing any impact yet?
Said they haven't seen a material change in customer behavior yet, but they know demand impacts are possible if things stay uncertain or get worse.
How do they handle that risk?
They point to their global footprint, their decentralized model, and those ABM tools as giving them flexibility to manage disruptions and tariff risks.
Tariffs manageable so far.
Apparently, yes. Short-term costs have been manageable, and they said contracts usually let them pass tariff impacts through.
Any other mitigation strategies?
Yeah, supply chain efforts like localization, working closely with suppliers. They also mentioned trade agreements like USMCA helping their Canadian operations for North American business.
And they had an interesting take on tariffs long term.
Yeah, they sort of spun it as a potential midterm benefit for them because their global setup means they can build systems in the region a customer needs it, potentially dodging tariffs that might hit competitors who manufacture centrally.
One last operational item, that internal control deficiency disclosure. What was that about?
Right, they explained it came up during normal testing as they adopted SOX requirements for the first time. Standard stuff for companies going through that.
And the issue was?
Related to some business processes and documentation, specifically around spreadsheets was called IP, or information prepared by entity.
But no financial impact.
They were very clear. Absolutely no impact on current or prior financials. Purely a documentation process improvement needed for SOX compliance.
And not related to the EV settlement accounting.
Explicitly stated, no connection there, focuses just on improving documentation in fiscal 26.
They also gave a shout out to some anniversaries.
Yeah, couple of milestones. Comair hit 50 years, CTF hit 80, and they got recognized again as a top employer locally in southwestern Ontario.
Okay, let's pull this together for investor context. Key takeaway.
The absolute key takeaway has to be the strong Q4 bookings feeding into that record backlog. That's the foundation for their expected profitable growth in fiscal 2026.
It's the forward-looking story trying to offset the FY25 challenges.
Exactly, especially those EV headwinds, which now seem resolved.
And what does this signal about their market position?
Signals confidence from management. They believe they can grow faster than the overall automation market, which they see growing mid-single digits. They think the demand is there in their sweet spots.
What else should you maybe read into this call?
Well, the EV settlement is big. Freeze the balance sheet, even if leverage needs to come down more for big M&A. Focus is clearly on getting value from recent deals. Paxiom, Haydoff, Midity.
Integration, cross-selling, efficiencies.
Right. And driving margin expansion through that mix shift to life sciences and energy, operational improvements via ABM, and getting transportation profitable. Plus, they're actively managing macro risks, leveraging their global setup.
Okay, time for our not financial advice segment. Pitch us an outrageous but plausible trade idea based only on this transcript.
All right, pure thought experiment here. Absolutely not advice.
Got it.
Consider going long ATS, targeting potentially outsized growth in fiscal 26, maybe even beyond.
The premise being?
The market might be seriously underestimating the combined punch of some very specific niche tailwinds they kept highlighting. Think about life sciences.
The GLP-1 demand, diabetes tech.
Exactly. Huge demand curves requiring super complex automation. ATS seems deeply embedded there, then pair that with the nuclear story.
Refurbs, new builds, SMRs, fuel production.
Right. Big capital, highly regulated, specialized automation needed. Now, the outrageous part.
Go on.
What if the momentum from just these specific niches, GLP-1 automation, nuclear SMR fuel equipment, advanced diabetes wearables, is so strong, and ATS is positioned so dominant within those niches that it drives revenue and margin way above current expectations?
So niche dominance driving unexpected acceleration.
Yeah. Faster growth, faster margin expansion, maybe faster deleveraging than people think. That could then potentially unlock M&A sooner, maybe even offsetting continued macro worries or softness elsewhere. It's basically a bet that ATS captures way more value from these booming, regulated, complex niches than the market currently gives them credit for.
Interesting angle, focusing on the power of those specific highlighted subsegment.
Again, purely based on the call chatter, not financial advice.
Understood. So, wrapping up, the big takeaways from fiscal 25 are the record bookings and backlog. That's the story management is telling for FY26 momentum.
Yeah, setting up for expected growth and margin expansion, focuses on core high-margin markets like life sciences and energy, leveraging acquisitions, driving efficiency via ABM.
While actively managing the external risks, tariffs, macro uncertainty using their global footprint and operational tools.
That sums it up pretty well.
And remember, everyone, this discussion was just for informational purposes, definitely not financial advice.
Please consult a professional.
So the final provocative thought for you to mull over. We heard a lot about the global push for energy security and healthcare innovation driving demand in very specific, complex markets. How much long-term growth potential is really hiding in those niches? And could ATS's specialized position actually let them capture even more of that value than anyone expects right now?